Okay, so welcome everyone to the next SAM virtual seminar series. We're super happy to have Shachar presenting Measuring Corporate Bond Market Dislocations, co-author with Nina Barichenko, Richard Crump, Anna Kovner, and I think Richard is in the audience, so he'll be also answering questions. And we're also super happy to have, in addition to our regular board members and panelists who've graciously agreed to attend the talk and participate in the talk. And they'll play a role of providing creating a lively audience. And so let me remind everybody the format of the talk. The talk is 1 hour, followed by 15 minutes of question and answers. During the talk, you can post questions to the question, I think this little chat here. And if it's a clarifying question, we'll ask or to address it. Or the co-authors can also answer the questions on the chat. And as the talk is nearing, please post your questions to the chat or raise your Zoom, use the raise hand feature. And towards the end, we'll unmute you and have you ask the question directly. So this applies to the regular audience members, whereas panelists can interrupt anytime they'd like. So with that, I'll move on. I'll pass it on to Or please take it away.
Perfect. Thank you very much.
I think you may want to do,
Let me. Okay. No. You would think that by now everything will be smooth. Okay. Okay. Perfect. So thank you very much. You can see my slide, right?
Yep, you can see your slide.
So thank you very much for inviting me to present in this great lecture series. As Bachimek mentioned, this is joint work with Nina Barichenko, Richard Crump, and Anna Kovner. We are all from the NERC Fed. Nina and Richard are both in the chat, so and they will help me as needed to answer questions. The views expressed here are those of the authors and do not necessarily reflect those of the Federal Reserve Bank of New York and the Federal Reserve System. So after this very lengthy opening, what are we trying to do in this paper? So in this paper, we are trying to think about how do we measure corporate bond market distress. In particular, we want to think about access to corporate bond markets. So while an individual firm may lose access to the corporate debt market for idiosyncratic reasons, when we have a widespread market freeze, there are potential to propagate through the economy and result in weakening aggregate economic activity. So the theoretical literature on frictions in that market, as all the people here know about, identified conditions that indicate when the corporate debt market is in distress. And specifically, what we are talking about is primary market issuance slows down, secondary market prices decrease, and liquidity dries up, and secondary market trading volume may or may not increase. So when we want to measure distress in the market, we have many measures to choose from. What we would like to do is to aggregate those measures into a single number that would indicate whether the market is in distress or not. So we don't have any preference to a specific measure. We trying to rely on the literature on as big of a basket as possible. And to do that, we took the perspective of preponderance of measures. And the basic intuition behind that approach is that we want to think about periods when more of the individual metrics are in the tail of their distribution as periods when the overall market is more likely to be in distress. We are going to do that at the weekly frequency for the corporate bond market, but you can do that in other frequencies as well, and also in other markets, depending on availability of data. So we do try to have many measures included in the index as possible. And the reason is that we are going to get an index that is less volatile overall, the more measures that we are adding, which from the perspective of identifying market distress is a good thing. We are also going to argue that because we include different measures to capture different aspects of the market, the index is less vulnerable to distortion by any single measure. Obviously, as you can expect, this comes at a cost. When you ask me to attribute a specific movement in the index in a specific week to a reason or individual measure, that is harder to do. So we are really focusing on this one number to capture distress in the market, and that's the point of this paper. And the point being is that the corporate bond market is in distress when many measures indicate that the market is in distress and pointing to the same direction. And I would like to note that we are looking at distress in the corporate bond market itself, rather than dislocation between related markets as been done in the literature before. So just let me preview the result. So first we construct this index. We call it Corporate Bond Market Distress Index, and I'll abbreviate that as CMDI very frequently in this talk. Then I'm going to argue that the CMDI correctly identifies periods of dislocation. And I'll show you that why it's needed to add those primary market metrics. And those are crucial for capturing the credit availability and access to the market. There are additional results in the paper that I'm not going to cover today. I'm going to cover a lot as is. For example, we show that the index is robust to individual choices on how we construct the index along the way. We're showing grandeur, causality with other measures and so forth. The other set of results in the paper are pretending to the question on whether periods of broad market distress are predictive of future real outcomes. What we are showing in that respect is that the CMDI predicts future real outcomes over and above the predictability that comes from credit spreads. And we show also the predictability in the mean as well as in the tails. We also going to show that primary market conditions contain differential predictive information than secondary market conditions. There is, as all of you know, there is broad literature on measuring financial distress. And due to the time, I'm not going to talk about and get into all the papers. What I do want to mention is in that respect that unlike the existing literature, the developed economy wide indices or individual financial institution, the CMDI really tackles the question on measuring market-specific dislocation, and that hasn't been done so far in that literature. And we are focusing again on distress in a specific market, not dislocation across market, as a previous paper has done, the Pasquarelli in 2014. Our paper also is related to the literature that shows relationship between credit spreads and real activity. And our work shows that the primary market conditions contain additional information, predictive information, than secondary market conditions has been done so far. Okay, so in the rest of the talk, first I will tell you what do we mean by bond market distress. I'll show you and take you through the steps of our empirical implementation. I'll convince you that primary market conditions are necessary when we're talking about distress in the corporate bond market, and the economic implications for the CMDI in terms of the predictability the predictability power of the CMDI. And if time permits, I'll talk on where we are today and what the CMDI shows you about the tightening cycle. Okay, so what is corporate bond market distress? Distress in the secondary market are episodes of liquidity black holes. Those are usually arise when financial market liquidity suddenly dries up with one-sided order flow. There are large differences between buys and sell prices, and only a small transactions can be absorbed without leaving a large impact on prices. But large prices changes themselves are not sufficient to say that there is a liquidity black hole. Large prices changes can actually reflect a smoothly functioning market that incorporates new information quickly. So we want to separate those two cases and really focusing on when functioning is the driver for price changes. Some would argue that capturing secondary market distress should be sufficient. So why are we arguing so strongly to use primary market measures in addition? So an answer to that can be gleaned from the Emergency Relief and Construction Act of 1932, more known as the 13th Relending Authority of the Fed. What it states here, and it's the last sentence in blue, is that in order to supply backstop lending, the Fed shall obtain evidence that such individual, partnership, or corporation is unable to secure adequate credit accommodation from other banking institutions. So in simple words, from a statutory perspective, distress of a market is characterized by a shutdown of the primary market itself, not inability to execute secondary market transactions in a quick manner without large price impact, as we usually think about market functioning. But at the same time, the two markets are connected, and this is why it's important to bring them together. So if distress in the secondary market coincide with or even precedes distress in the primary market, then we wouldn't talk about why it's needed to add these additional measures that are coming from the primary market. What I'm showing you here is the relationship between amount outstanding in blue and the EBP, the excess bond premium from Gilchrist and Zarkichak in black. So what we are showing is the quarterly growth rate of the total non-financial corporate bond amount outstanding from flow funds and the average EBP over the quarter. We can see that at least contemporaneously, the EBP is unrelated to changes in bond amount outstanding, so that quarters with high EBP, are those spikes here, are not quarters with slowdowns in corporate bond issuance. To us, this suggests that they are linked, as we know from the literature and from this figure, but conditions in the primary and secondary market are not synchronized. So what we want to show is that the corporate bond market is in distress when both markets, the primary and the secondary, are struggling. Those are times when borrowers cannot access the primary market and the secondary market experience liquidity deterioration at the same time. So, yeah.
So, will your measure perhaps capture also dislocations that are a bit more persistent? So I can imagine that if there's a huge change in the EBP that expected to go away rather quickly, this may not be enough time for corporations to just issue a lot of that. But if you have like more persistent changes in the EBP, this is exactly when you're going to see this translate into primary activity as well. So do you have something to say about like this more high frequency movements in the EBP versus actually more persistent changes in spreads that actually may translate to effects on issues?
So part of that we can see here when we're looking at the contemporaneous relationship between annualized corporate bond amount outstanding growth and the default adjusted spread and the predictive spread in the current quarter versus 1 quarter ahead. So yes, there is this same thing about persistence in the EBP that reflects it in the longer longer term, but in the short term, it's actually not helping us to predict. Does that answer some of your question?
Yes.
Okay. But yeah, there is this, when we are including it's similar when we're including the primary market issuance, those measures tend to be lumpy and they're slow to adjust, as you are indicating. But in those stress events, actually, sometimes the primary market leads the secondary market. And those are the points that we would like to focus on and pick in time. So as I mentioned, just to explain this table more clearly, is that we estimate contemporaneous and predictive regression of annualized corporate bond amount outstanding growth rate on a constant, legs of the dependent variable, and contemporaneous real effective federal Fed funds, and the 10-year to 1-year constant maturity treasury swap, as well as the corporate bond market condition metrics. So we see that, at least contemporaneously, there is no relationship between EBP and the net issuance in the first column. As for the amount outstanding growth as well, only in the third column, there is statistically significant relationship between EBP and those changes in amount outstanding. But those are actually in the wrong sign as well. So increases in EBP today actually predict increases in amount outstanding in the future. So overall, if we are taking the figure, eyeballing and these results in this table, so the conditions in primary market and secondary market are potentially asynchronous, and we would like to identify those periods when both are struggling to function well.
Hey, Or,
yes.
A question for you, since it looks like you're emphasizing this need to capture both conditions in the primary market and in the secondary market. So, and maybe this is beyond the scope of your paper, but what are the frictions that prevent both secondary and primary markets to be kind of, integrated? I mean, are there like different market participants that are purely buying and selling in the secondary market and not participating in the primary market? Or what is it that you have in mind that creates some type of segmentation?
So that's a great question that this paper is beyond. What I can hypothesize is, yes, we have in mind segmentation, as well as the primary market is driven by the demand from the issuer sides, rather than in the secondary market, you're talking about investors. So those are clearly a different set of drivers to those two markets. Yeah, but it's definitely, in stress time, you see them being more in sync than in normal times, which sort of makes sense based on the theory. But that's what we have in mind, segmentation, unless, yeah, but we are not getting into the to that channel. What I'm going to show you later a bit about the mechanism is how the dealer constraints interact with the CMDI. But that's as far as we are going about to explore mechanisms. Okay, so.
Can I just ask a question?
Yeah, sure.
Yeah. So if they are kind of segmented or measuring two different aspects, aren't we losing information by aggregating them? So wouldn't we be better off with two measures instead of one? And can you kind of tell me or reassure me that they're not?
Again, so what we want to capture is access to credit markets. Now, in order, the two are fitting of each other, right? In order to issue in a certain price, then you go to the secondary market to see where things are traded now in order to price the primary market. So they're definitely linked. What we want to, the point that I want to make across here is that we want to have, we are going to have a better signal when those two markets are moving in the same direction. Those are the time when things are in distress. If we are having, like, it's rarely happens when we have an issue with the primary market and not in the second, that doesn't feed later into the secondary market, and vice versa. But if we're looking, for example, on the summer and there are no issuance, are you going to say that the primary market is in distress? Not really, right? So we have to think about more generally about how those markets interact together.
Yeah, I'll leave it there. But to me, like what you said, kind of sounds as an argument for having two measures and an interaction with these two measures in a economic.
In a sense, that's what we are doing. So the interaction between them are going to be how we are measuring the similarities between all of those measures. So I'm going to get in that, but that's like the interaction is what drives the CMDI construction. And if it's not going to be clear when I'm going through all the steps, then I can come back to that point. But you're right, like we're measuring signals separately from the two markets, and the way that we're combining them is to see if they are pointing in the same direction. So if the interaction is moving in the same directions, we are going to weigh those signals more than if they're in opposite directions.
Now,
and it's going to be clear in like a couple of slides. Yeah.
Or let me try a different take on it. Your institutional mandate, as you indicated in slide 2 or 3, is to the primary market exclusively.
In terms of the ability for the Fed to lend, yes.
So, but the secondary market, the advantage there is as an informational variable. You can monitor conditions there very frequently. So in some ways, this is kind of a Midas kind of, mixed data frequency problem, where you have a high frequency signal that you hope is going to help you predict a low frequency variable that is a primary, that's not, shouldn't use primary here, that is of the most importance.
Yes, so I wouldn't say that the primary market or the signals that we get from the primary market are low frequency. They tend to be lumpier, but we can see them as frequent, like every day there are some issuance almost. So it's about how we interpret. But you're right that in terms of the Fed ability to intervene in the market, that is going to be driven by the primary market access rather than secondary market. Now, in the credit, corporate credit facilities, if we only add issue in the secondary market, it would have be a harder sell to provide support there than as was the case that you saw a dried up and freeze in the primary market that later in a few days later translated to issues in the secondary market. But in the sense, the low frequency that we want to measure is those periods of inability of the markets to function properly. Yeah.
Thank you.
Sure.
Can I ask you, since you're related here to your last bullet, that you are monitoring credit flows, but then surely, I know you're interested in looking at corporate bonds in isolation, but surely in your, getting informed as to whether you should intervene, you would be interested also in looking at substitutability, right, into bank loans and other private direct lending and stuff. So doesn't the measure in somehow needs to be supplemented by these kind of other lending indicators?
So the majority of lending in the US is concentrated in the corporate bond market. So we're not losing a lot of information by focusing on the corporate bond market. But you're right that if we wanted to understand better the access of the small investors and small firms into market, that the loan market is something to be considered. And there is a paper by Shachar and others that doing something similar to that with loan data. And it's definitely an important part of the market, but again, the main driver when you're thinking about the real economy are, in the US at least, is coming from the corporate bond market rather than the loan market. And again, if we're going back to, I shouldn't do that, but to scenarios when the Fed would intervene, it's easier for the Fed to intervene in the corporate bond market rather than in those the other markets, the loan market. There are other ways, not as a market functioning support. Okay, so I sort of indicated about that earlier when I answered one of the questions, but let me explain it better. How do we actually combine the information about different aspects of the market into a single indicator? So a simple average of multiple measures is often what we are defaulting as researcher, or if we want to be really sophisticated here, we are going to use a PCA. But here, identifying distress, it requires measures of different aspects rather than different measures of the same aspect. So in that case, we want to put more weight on measures that provide more similar information to other measures in distress times and downweigh conflicting information. So here I'm giving a very simple example about the difference between average metric and distress along a greater number of metrics. So let's suppose that we only have information about beta spread and depth as a measure of market functioning. And in one scenario, say that the beta spread is in the top 10th historical percentile, which would indicate that the liquidity in the market is really poor. And the depth measure is going to be I in the top 10th historical percentile, but that shows a good signal about market liquidity. In the second scenario, we have both beta spread and market depth at their corresponding historical medians. So no extreme realizations, they're both at their median. So which one is more distress? That's a hard conclusion to reach. So if we're looking at the perspective of a single measure that just take the average across metrics, obviously the market distress is at the same level in both situations. They are both at the center of the distribution. But if we're looking at the measure that identifies market distress as distress along a greater number of features, we'll perceive the second situation as being potentially more concerning, as the signals from the first scenario are just going to cancel each other. So in practice, measuring similarity is complicated by variations in how we are observing the signals. The problem in identifying the similarity of features is extensively studied in machine learning, in particular image recognition and language processing. So if we're thinking about facial recognition, for example, we can have images of the same face, but they can vary if the person is smiling or crying, the light, how old they are, and so forth. But they are still the same person. And the machine learning literature suggests a way to, in order to measure those similarities across the images. So what they are offering us is to put all measures on an equal footing. And you do that by standardized using the empirical cumulative distribution function. And then you reduce the dimensionality of the measure to extract a compact vector. So it's, in our case, it will be done by sub-indices that capture different dimensions of market functioning. And the third step is to evaluate the similarity of this reduced feature vector. We take the pairwise correlation between the sub-indices. And that's what I indicated in one of the answers, that's the interaction where when we are putting more overweight on signals that are more correlated. So I'm just going to jump into the data. There is a lot of data involved in estimating this. We are using Trace, which is a secondary market volume, secondary market transactions. We can measure volume, liquidity measures, and spreads. We are complement that with emergent FISD, bond characteristics, and measures of issuance. We are also adding quotes from ICE and Bank of America. That is important for periods when things are not frequently traded, and we are going to calculate spreads for non-traded bonds as well. And we are going to complement that with the KMV EDFs dataset in order to adjust for the default component of bonds, and and we're using the EDFs to include both public and private companies in our datasets. For obvious reason, this dataset is very large with 34 million bond trade observation, about 30,000 QSIPs, and more than almost 3,000 issuers. So that's a very comprehensive dataset, and we're trying to capture the broader market as possible. Based on that,
I have a question
yeah.
on the data set. So Trace Enhanced, I think, also does include primary transactions since 2010. Would that also add to the information?
So we are not adding that. We could add that. That will provide information about prices, not all, and volumes. Volumes, in some sense, we can measure for emergent FISD and offering amounts. What you can do with the primary is basically to look more fine into what dealer are doing. When I should have mentioned that earlier, we actually posting the CMDI publicly every month at a weekly frequency. And when we constructed that, we had in mind the ability of others to be able to replicate that quite easily. So we were trying not to rely on enhanced trace. Obviously, we're using enhanced trace to have the full volumes rather than capped and so forth. But we were trying to not going down the road of the dealer level measures for that reason. But the primary market we could, but I'm not sure how much information it would add beyond what we have right now, but we can definitely try to add that again, like for the spirit of add as many measures as possible to our approach. That's something that we could add if proved to be significant, yeah. And I should say, as you mentioned, this is available from 2010. We were trying to go as far back as possible for the reason that in the second part where we're focusing on real activity, we do need more, the more data, the better in those predictive regressions. So we have 15 years of data for that. If we would condition on another variable from 2010, that will shorten to by 5 years. But again, something to consider definitely.
Can I also ask a question at this point? So it seems like as issues stress a lot, you know, the supply that is given by the bond market. So what I was kind of expecting here is that you look a bit into the holdings. So who holds these securities? And you kind of try to, you know, get some funding measures from the holders of them. For example, if you see the insurance sector, you know, has issues that may tell you a lot about purchases in the primary market and hence a lot about new supply.
Yeah,
or it's different types of investors, you know, if they have at the same time issues, then you know, it's harder to kind of trade. And so I was kind of expecting to, you know, have some information about who is actually the buyer and who are actually the sellers and how, you know.
Yeah, so to that question, it's something that we were thinking about. Unfortunately, holdings data is available on a quarterly frequency. If we are thinking about pension funds and insurance streams, they are reporting at the end of the quarter going back. One thing that we've tried to add to that machinery is to look at mutual funds holdings. But again, it's more, it was hard for us to update on a regular basis, and it didn't add as much as we would hope too. But definitely, like if we add, so the UK central bank has amazing data that like a trace version that includes information about clients. If we add that kind of data, we would be happy to add such measures into that machinery. And again, if someone from the UK central bank wants to try that, we would be happy to help them construct. But yeah, there is a tension between what is available, how frequently it's updated, and we would hope that we are showing you here an approach that hopefully you would find interesting and acceptable, and then you can fine tune with better data is if that would be collected in the future. But the core is just to show you the machinery today and to show its value in terms of the predictive power of real outcomes. So what we are including is weekly measures of secondary market activity. We are, as I said, we are trying to be as comprehensive as possible, and we are happy to add more if someone has a preferred measure. We are not running any horse race here among measures. Any measure is welcome. So, but we are dividing them to 7 sub-indices, 5 from the secondary market and 2 in the primary market. In the secondary market, we have a volume sub-indices that are looking at about flows of dealer to customer and volume and the ratio between the dealer to customer to total volume. We have a liquidity sub-index, a traded credit spread, a traded default adjusted spread, and a quoted default adjusted spread. If you have any questions about any of them, I'm happy to get into the details.
Yeah, I would have one question. Yeah. So of course, if you present the list, there's always the risk that someone wants to see something else. But if we want to predict market distress, then somehow my question is if we maybe get more information from speculative grade borrowers than from the whole market. Maybe we see problems first in the speculative area.
You were breaking up a bit. What can you repeat the last sentence, please?
Yeah, so my question is if we would learn more from speculative issuers, so not from the whole market, but focusing on speculative grade issues.
So we are including both investment grade and high yield. If your question is about why we're not adding the loan market, that's a similar answer as I said before. The corporate bond market just captures a bigger share of the economy in the US. But we are capturing both investment grade, high yield, and non-rated even.
Yeah, that I understand. But my question is whether you should focus on speculative grade bonds. Maybe
okay, so as I'm going to show, so if I'm going to get into that, like for example, in today's cycle, investment grade is actually showing a stress while the high yield doesn't show distress. So actually looking at the market level as well as how high yield versus investment grade evolve over time does give us more information than just focusing on high yield. So I think when you'll see all the moving parts, you'll appreciate it more. And in some sense, the fact that investment grade is more liquid, and as we know in stress, people tend to sell first the liquid part before they're selling there's more speculative and less liquid part. Then sometimes stress is driven by, or you can see it sooner by the investment grade sector rather than the high yield. But all those relationships are things that we're getting into in the paper, and hopefully I'll get to some of that today.
Or you have about 20 minutes left.
Okay.
So a related question perhaps is whether or not you could measure bid-ask spread separately for agency and risky principal trade.
We could do that. We can consider doing that. Yeah. Thanks. In the primary market, we are looking at primary market issuance and primary default adjusted spread. So as I mentioned, we have those 3 steps. We first standardize each individual metric using the real-time empirical CDF. We then do creating those 7 sub-indices. as a simple average of the standardized metrics in each of the lines that I showed you previously. And then we compute time varying correlations between the 7 sub-indices. The final result is this CMDI, the corporate bond market distress index, which is the correlation weighted average of those 7 sub-indices. I mentioned real-time empirical CDF. That requires us to have an initialization period, and this is why more data works better for us. We are using the window between 2005 to the end of 2006 as that period where we are calculating those empirical CDF. And then that machinery is using for the economy-wide index by the Bank of the BOE, and have this KISS measure that they are doing that for financial stability monitoring.
Can I ask a quick question here about the group of non-traded bonds? So whenever transaction records become available in trades, will they then drop out of the non-traded sample in that way?
No, so the non-traded, so we are using, if it's traded, we are using in the traded basket. The non-traded is a slow, we are using the quotes for both traded and untraded.
All right, so it means that the same bond can be in the same week in both the trace sample and in the quote sample.
Yes, correct.
Okay, but wouldn't that imply some correlation between the two groups then?
It would, yeah. But the quotes doesn't necessarily move in the same direction as the traded prices. So, yeah.
All right, thank you.
Sure. Okay. So I'll try to be brief given the time here. So just to better understand, so we can get into the final plot of the CNDI is we are going to focus here on individual measure in a particular sub-index. So as an example here, I'm looking at the biggest spread throughout those 3 steps. So you can see that in blue, the time series of the biggest spread, it jumped in 2008 and then recently in March 2020. So at each point in time, we are going to see how the beta spread measure compares to all beta spread that have observed up to that point. So if we are standing here in January 2008, we're going to observe a 70 basis point realization, and we're going to compare that to all the previous realization pre-2008. So we don't have the future realization, obviously. It's all done in real time. So given this information set, we are going to say, this looks like a pretty unusual realization of the beta spread, and we are going to take that into account through the sub-index. So this is in black when we are standardized the series, and the real-time empirical CDF is going to put more weight on realizations that are high relative to what already been experienced in the past. And lastly, if we are going to compare the real-time empirical CDF to the full sample empirical CDF, we can see that the real-time empirical CDF sometimes think that observations are in relatively high percentile, but as the series gets more and more observations and observe more market distress, the valuation can change over time. So every time that we calculate, it depends on the information set that we have in hand. So the reason why we use the real-time empirical CDF is that we would like to think about the index as an index that you could construct in real time going back. So when we're talking about later about predictability, this is coming from the index for the relative. This is actually coming. This is predictability, and not just because we looked back at the financial crisis and realized that the financial crisis as the bigger outlier. So it's also the prediction, the predictive regressions are going to use these real-time realizations. Now, the beta spread is part of the liquidity sub-index. This is what the final sub-index looks like. You can see that each individual sub-index can still be a little bit noisy, but the final index winds up to be very reasonable and what you would expect to look like. In the third step, and that this is where the big power of this machinery comes from, is that we compute the time-varying correlations across different sub-indices, looking at the liquidity sub-index as an example. This is time series of correlations with liquidity index with the other 6 sub-indices. You can see that it is important to do this correlation in a time-varying way, because it's not only that the magnitude of the correlations change over time, the sign also can change over time. So the correlation in the time varying allows to recognize that the market evolves, the relationship also of the underlying individual metrics can also evolve. And especially as the corporate bond market structure has changed over the time period that we are looking at. And someone mentioned the agency versus the non-agency trading. That's something, for example, that the time varying correlation will help us to capture that change in market. And finally, we're going to use the correlation weighted average to construct the index itself. We're going to take the vector of the sub indices at each point in time, pre and post, and multiply that by the correlation matrix RT here. We are going to take the square root to maintain the interpretation of having an index that is comparable to an equal weighted averages. But if you are going to ask me about contribution, it is going to think about index square in terms of the contributions here. So here I'm showing you the weights this construction puts on each sub-index over time. And corresponding to the correlation matrix fluctuating both in magnitude and in sign over time, the weights are also going to change. So you can see some of them are positive over time, some are negative. And if we combine with what each sub-index looks like, it tells us the contribution of each sub-index to the overall construction is going to change over time. Yeah. Okay. Any questions? I should mention that if the RT is the identity matrix, then it's going to amount to a simple average. Okay, I think okay.
There's a question by Ben. Ben, if you want to ask your question.
Oh, I was just wondering if when you're looking at these empirical CDFs, do you guys allow for sort of trends in some of the, I guess, dispersion or volatility of some of these?
Yeah, we are adjusting for trend and seasonality. We are trying to be as careful as possible not to get those econometrics issues trickle down to the index. Yeah.
Okay.
So finally, I get to the masterpiece, the CMDI. This is the full sample of the index. The gray shaded periods are areas are NBR recession. The orange areas are the euro debt crisis here in 2011, the US manufacturing crisis in the 2015-2016 period. So you can see that the index goes up precisely at the periods that you think it should. The great financial crisis, COVID-19, the euro crisis, and so forth. And I want to just stress that while prices inform the CMDI, it measures the market functioning, not market values. So that's an important distinction to keep in mind. Okay. Okay, I'm just going to be really brief because one of the questions was about the mechanism. So I think looking at that briefly will be interesting, and then I'll skip some of the other results. So to better understand the mechanism at play, we are examining the predictive content of the average 5-year CDS spreads for the G14 dealers. And that, as you all know, is a commonly used proxy for dealer balance sheet constraint. And we are looking at that for the future externalization of the CMDI. And what we are running here is a probability regression for the probability of future CMDI realization in the historical 75th percentile as a function of the current level of the CMDI and the G14 dealer CDS spread. We can see here that higher dealer CDS spreads predict higher probability of the CMDI, rising above the historical 75th percentile up to a quarter ahead. So that's pretty long time in terms of the effects of dealers' balance sheet constraint. And you have the empirical magnitudes here, so it's both economically and statistically significant. In terms of as I mentioned, we can dig deeper into the contribution of each sub-index to the overall index. So we can take each sub-index and run a similar regression on the G14 CDS spread. We can see that the average 5-year CDS spread is significantly associated with contributions to the CMDI from credit spread, both the duration match and the default adjusted spread, the secondary market liquidity year, and the quoted prices and primary market spreads. And in particular, 5-year CDS spread is higher, so that dealer balance sheets are more likely to be constrained. Contribution from those sub-indices with the 3 stars are larger. And in the paper, we are going to show that the relationship is actually post 2007. Okay, I'm going to skip that for the interest of time, and I'm going the other way. Okay, so I think I was pretty, I stressed enough the importance of the primary market here. Here is another motivation that is coming from the corporate credit market intervention. Again, the purpose was ensure ease of access to public debt markets. So if we want to look at that more formally, we can follow the same procedure in building the CMDI to construct separately a primary corporate bond market condition index and a secondary corporate bond market condition, as well as the correlation between the two indices. The primary market is going to use only the primary market issuance and primary secondary spread sub-indices. The secondary market is going to use only the secondary market 5 sub-indices. So when we're looking, so the CMDI here is in blue, the primary market CMDI is in black, and the secondary market CMDI here is in green. We can see that that the information in the primary market condition is distinct from that information of the secondary market conditions, with slowdown in the primary market sometimes occurring without slowdown in the secondary market conditions and vice versa. So this is where the relationship between the two is important. We might have to think more about the story that we have behind that lead lag effects, and maybe add that to the paper. Okay, so.
Or can you go back to the graph?
Yeah, sure.
It looks like the green and the black are more correlated. Wait, sorry, the green and the blue, right? The main CMDI and the secondary market CMDI seems more correlated with each other than the main CMDI, the blue with the black, right? So can I interpret this graph as saying most of the driver seems to be secondary market indications?
Not necessarily, because it depends when the reversion of the direction of the CMDI happens, and that's not necessarily, it's not going to show up only in terms of the correlation between the two. And again, primary market measures tend to be lumpy, and this is why it looks noisier over time. But in the inflection point, the primary market might actually add more into the change of direction of the CMDI.
Maybe yeah. So then maybe would you be able to highlight particular historical episode where it's suggesting that according to your main CMDI index that, you know, New York Fed should have intervened and supported markets, whereas if you had just looked at secondary markets, you know, you wouldn't get that kind of signal?
We can get into that more in detail, but you can see here, even in 07, 08, like when in the inflection point, it's the jump in the primary market that driven the CMDI. But yeah, we can get into more of that. And I think there is some of that in the paper already, but yeah, we can be definitely be more careful and thoughtful about that. Okay, so in terms of one of the things that I want to show you next, I showed at the beginning the predictability regression about access to credit, the relationship between amount outstanding and the EBP. So here we are going to show the results of an annualized log change in amount outstanding over each quarters ahead. We see that the primary market CMDI has statistically significant relationship with net issuance and current quarter amount outstanding growth, with higher levels of primary market CMDI corresponding to lower issuance and declines in amount outstanding. The secondary market CMDI is unrelated to primary market conditions. So again, this is indication of the asynchronicity between the two markets. While the secondary market conditions may affect the future willingness of dealers to underwrite corporate debt, as well as the willingness of firms to borrow at higher rates, they don't appear to have an immediate impact on primary market conditions over the entire sample. So I think it was quite convincing in how we can identify periods of broad distress in the corporate bond market using the CMDI. Now the question remains, are the periods of broad market distress predictive of future real outcomes above and beyond what have been shown in the literature? So to answer that question of whether information about the corporate bond market distress contain additional predictive information for real outcomes over and above the credit spreads, what we are doing here, we are regressing cumulative one-year add growth rates in real outcomes on lagged real outcomes, and the risk-free interest rate and credit market conditions. We use monthly data on industrial production and unemployment rate, and quarterly data on investment, real GDP, capital expenditures, and sales. Given that the CMDI is at a weekly frequency, we average within period to match the periods. And this is where the longer time series that we have, the better predictive power that we can get. So what we can see here when we're using the market CMDI, we can see that across all measures of real activity, industrial production, unemployment rate, and so forth, a higher level of CMDI, which signals more distress in the corporate bond market, is associated with a reduced real economic activity over the next year. And again, those are both statistically and economically meaningful and significant results. The other result that we are showing is that the predictability is over and above those of the GZ spread. So you can see that for all of the measures of real outcomes, the CMDI remains statistically significant, at least at the 5% significant level with 1 star. The GZ spread is not statistically significant in most specification. The only exception is the unemployment rate, but both CMDI and GZ spread are still statistically significant. So there is definitely a room to add the CMDI as a predictive power. Lastly, if we're thinking about other method of weighing the signals, for example, the PCA, we can see that the market CMDI still dominates when we are regressing, we are running those predictive regression controlling for PCA. Okay. So just if I'll get a few more minutes to cover where we are today, because I think it's interesting and it touch about some of the questions that were asked before. This chart shows the investment grade CMDI, the high yield, and the market level from January 2022 to February 2023. The investment grade is in black, the high yield is in green, and the market level is in blue. And just to remind everyone, and with some context, the FOMC started increasing the target range for the Fed funds rate in March 17, 2022. So when you compare the market level CMDI to the investment grade and high yield, you get this puzzle. The high yield index, which is in the green line, remains just below the historical median, but the investment grade in black is in the top of quintile, indicated strengths in the market functioning. So that's kind behavior. The disparity between investment grade and high yield is kind of surprising. We got a lot of questions about since that CMDI is public. So our explanation is twofold. First of all, I repeatedly emphasize, and you ask many interesting questions about that, about the primary market access to of investor to the primary market. So in particular, CMDI includes measure of issuance volume. And we compare those both normal issuance volume for the week of the year, as well as the anticipated amount of that might roll over in the near future. So when we're taking that into account into the construction, that information is also incorporated in the primary market CMDI. So the figure here shows the issuance of investment grade in blue, in red the high yield, and the green the non-rated, which is a smaller sample, obviously. We can see that issuance measures have been particular strength for investment grade in the 2022. And this is because they just issued a lot during 2020 and 2021. So it seems that the current slowdown that enters the index in the issuance, it's sort of a payback for the market exuberance over the prior 2 years, rather than just a breakdown of today's primary market access to high quality borrowers. And then the other part is that the CMDI movement during tightening cycles, we are going to compare the current cycle to the previous cycle that began in December 2015. The figure here shows the CMDI during the previous cycle in 2015 in blue. In red, that's how the CMDI is currently moving relative to the Fed funds rate targeting back in 2015 and the Fed funds target currently. So over the course of 2022, the FOMC tightened monetary policy very, very quickly. And what we can see that despite the pace, the fast pace of the monetary policy tightening, the CMDI remained relatively small. So we can see that the market level of the CMDI in red stayed constant around the 65th percentile and has been normalizing since then. So how is that going back to the investment grade versus high yield puzzle? So we can see that the peak of the investment grade CMDI, this is in blue here, reached the 2022 peak almost at the same time that it happened in 2015 in terms of weeks since tightening. But investment grade CMDI since then stayed at those very high levels. So the sharp change is likely reflecting not only the tightening, but also other geopolitical uncertainty that happened at the same time in Russia and Ukraine. And the duration is both in the primary market as well as the secondary market metrics here. So just, yes, I'm just concluding, and I think I'm on time relatively. So I showed you that we can identify periods of broad distress in the corporate bond market using the CMDI. It correctly identifies periods of dislocation. And I'm also showed you that CMDI predicts future market conditions and real activity, both in the mean and in tails, and more of the details in the paper if you're interested. Yes, and I'm happy to take any other questions now.
Okay, thank you so much, Or. So we'll now open the Q&A section from attendees. If you have any questions, please post it to Q&A section or use the raise hand feature. In the meantime, panelists, feel free to jump in with questions.
Or I had a quick question. If you look, I think you flashed it kind of quick, but the CMDI looks like it was actually a bit, a bit lower pre-2008 crisis and all the regulations that followed relative to post. So was that surprising to you guys that because there's been a lot of talk about the corporate bond market being, dealers having less inventory and less depth in the market?
If what was surprised,
I guess part of me probably expected that these kind of after 2011, 12, where somehow like the steady state or normal level of functioning in the corporate bond market would be higher than pre 2008, given like the narrative around liquidity and stuff, regulation, all that. So I was just curious if you guys had thought about that.
So I think it depends where you're looking at the distress in the corporate bond market. As I was mentioning before, the time varying correlation allows us to capture some of the evolution. So a lot of the stress or changes in the market, as you mentioned, the dealers moving from principal trading to agency trading, but at the same time you have electronic trading coming in to compensate for that. So I think overall, when you're looking at liquidity measures in that market, the deterioration happens during stress events. So it's when market becomes stressed, you don't have this dealer balance sheet, the utilization that you had before to rely on. And I think that does show up in the CMDI. But I think if you ask, like, it depends who you ask in the industry. If market today is better or worse than it was pre-2008, you get different answers. So some would argue block trades are harder to do today. At the same time, you have the ability to do electronic trading and you have the package trades. So again, we have the data. That's what the data shows us. And we can think about stories to about the drivers behind it, but that's what we see, in the data. And I think that's consistent also with other papers. So at least consistent with some of mine.
Well, also it goes back a little bit to my question before, which was, I guess if you're accounting for certain trends, then what we should really be looking at in this index is kind of like the flux, like the spikes in it relative to whatever the sort of current benchmark is. Okay. I don't know. Anyway,
yes. So the CMDI is scaled between 0 and 1. So depends how you want to think about the spikes.
I think that you emphasize a lot here the importance of looking at the primary market, and I think it would be interesting to dive a bit more on that. Like when you show the composition of the two sub indices, it really seeing that the secondary market is doing a lot of work. But you mentioned, say, look, if you look at the turning points, then it becomes important. So I guess perhaps showing, I don't know, some of the regressions that you show later with the predictability regressions, where you replace your index by the two sub-index, and then perhaps also an interaction term between the two, and show that, well, when you add the primary market, then it's for the predictability results, they are absolutely crucial. They're also going to help us understand like the importance of only looking at this secondary market and how much real information is coming from primary market.
That's a great suggestion. We'll definitely include that in our to-do list. I think Vilena has a question.
Yeah, go ahead, Junior.
Yes. Also, on one of the slides, you showed us the correlation, the time-changing correlation between the sub-indices. And one thing I noticed is that they change very frequently. And do you think the change in the correlation is driven by some of the underlying, for example, abnormal periods of the market? And do you think like this time varying weights will exaggerate or downplay certain episodes relative to others according to your index?
Yeah, so definitely to the first question, I think they play an important role. As for the second, I'm not sure that I follow the second part of your question.
So yeah, I'm just asking because maybe the time varying correlation is driven by some change in these two markets, in primary market and secondary market. And when you use these ways to average those sub-indices, I'm not sure whether you're exaggerating or you're kind of inflating the index, or I'm not sure if there's a right benchmark, but I can see that the weights play important role in addition to the percentage in the empirical CDF. So I think you're putting more weights on certain indices relative to the others, but these weights are also driven by the correlation, by the fundamental change in the market.
Right. So I think I agree with everything that you said. I'm not sure that what's the question at the end?
Yeah, so
yeah, let me
just try again. Then if it doesn't work, so we can leave it to the after the discussion. I'm just saying that because the weight is changing, then maybe for example, certain market change, market stress drive down the correlation between certain two indices, and then because the correlation is down, you're kind of removing the effect of certain indices in your final index.
If they're pointing in the same direction, then no. If they're highly correlated with each other, and then they will get the higher weight.
For example, let me give you an example. Suppose the fundamental change in the market is reducing the correlation between two indices.
Yeah.
And maybe this signals some abnormal periods of the market, but because this reduced
I see what you're saying.
correlation, your final number will go down. So
that could be, but at the same time, usually, so far market changes have been brought into normal periods of time. So I think when those market changes happened, for example, it didn't happen in 2008. It happened after the regulation were implemented, SLR and so forth. So there were a few years of normal times where those market changes had time to evolve. And I think that CMDI does manage to capture that at the end. Again, it's not, I agree with you. If it was instantaneously, it's not going to capture that. But usually market changes are not happen overnight, and they are slow to unravel in the market. So I agree with you. If that were the case, that market changes are going to happen in a very short time, the CMDI, unless again, it will immediately affect issuance and other measures, that wouldn't be captured. But so far, historical experience, that has not been the case. So hopefully that relationship is going to remain. But
thank you. Just a quick follow-up comment. So maybe you can decompose the change in your index into change driven by the correlation and change driven by each subindex, by the level of each subindex. So I would be interested to see that decomposition.
Yeah, so in the paper, we are showing both the correlations across the index for each of the index. I showed you one over like the liquidity correlation with the other indices. Like in the paper, you have everything there, as well as the contribution over time. So yeah, you can. Milena had a question.
Yeah, I just had a very broad picture question that I should have asked at the beginning, but then I didn't want to interrupt, which is I didn't understand whether the ideal measure that you would want to construct captures the exogenous shocks to bond markets that cause distress, or whether the ideal measure you want captures the endogenous responses of the financial market. If it's the second, which I think is the only thing you actually can do, like realistically, then conceptually, it's hard for me to aggregate endogenous responses across market segments that function differently, because the primary market is different from the secondary market. And then I also, if it's endogenous responses, the responses probably include stuff that the Fed does, which we might not want to include in the measure, or maybe we do. So I wasn't sure
So luckily, so it depends on what you mean. So first of all, it's the second. It's the endogenous reaction of the markets and the measures to those shocks. But in terms of, I don't know what you define as the Fed intervention, like so far, other than the 2020, the Fed hasn't been intervening in the market and doesn't plan to intervene in that market going forward. Again, moral hazard issues and so forth. So we're not taking into consideration. And I'm trying, yeah, and again, like if we're thinking about that period in time, the purchases were a very small amount. So we are not taking the Fed purchases out of the measurement there. But again, from knowing the magnitude, those are not going to affect the liquidity measures, the secondary market measures so much. They are going to affect the spread, the adjusted spread. But again, that's part of what you want to do. I'm not sure that I fully follow why you don't see the connections between the primary market and the secondary market if you're assuming that the endogenous response.
No, I definitely see the connection. So that's for sure. If I were to write down a model of the primary market and the secondary market, it's not clear how to aggregate responses and whether one or the other should be stronger or the directions and so forth. But I'm making it too complicated.
Yeah, so I think like from market experience, the way that the connection sort of is driving when issuers coming to the market in order to issue new bonds, they are usually looking at the secondary market prices to price them. So this is where the connection between, even though they are segmented, the issuers and the investors in the pricing of the new issuance, this is where it takes into the endogenous effect between the two market happens. But happy to hear other stories of other people.
There was one question from Bruno in the Q&A. He says, should we some way capture the speed of change or sudden movement? Maybe realization is not unusual, or is not unusual, yeah, but got there in a unusual way, increasing or decreasing very fast.
Yeah, so the speed is an interesting thing. Yeah, it's something that we might want to consider. I'm trying to think if any of the measures gets into that, but I don't, like I thought like a slope measure will get into the pace, but yeah, that's an interesting thing to think about.
I have also kind of this more big picture thing following up on Milena. So I think I was a bit confused about the following. So it seems to me as if your ultimate objective is to say something about investment and how, supply of debt, of corporate bonds affects investment, okay? And then the supply of debt, of new debt, like we would do it when you care about loans in banking, is determined in the primary market, okay? So this is I think, good. Now, what I didn't quite get is, first, if that's your goal, why you don't focus right away on just the primary market? And, so what's the additional thing that comes from looking at the secondary market? Also, given that we kind of know that they are disconnected, right? Because flipping is kind of a pronounced phenomenon. There's the paper of Kerisiani. She would say, these two markets are kind of disconnected. So then I wonder, why are you not just looking directly in the primary market and maybe look at something like, oversubscribed, so if there are months in which more is oversubscribed, there is a positive supply shock, and in others are negative ones. And then I think I just conceptually, I didn't, if I had to write it down in terms of, a second stage, the first stage type of setup, I wasn't sure. Why you don't
question-
just try
yeah.
to predict what's going to happen in the primary market, and that's what matters for supply, right? So
Yeah, so my answer to you is twofold. First of all, and that goes back to Joel's comment about the low frequency versus high frequency. So the secondary market, while it's not low frequency versus high, it's like just another signal that sometimes work better than only the primary market. So it does, looking at the secondary market, given the connection between the two, even though they are not necessarily happen at the same time, they are connected and they are linked. It does give us additional information. So that is one. It's not that by ignoring the secondary market completely, we'll get a better index. The second thing about adding the secondary market, if you're thinking about functioning of the market and when Fed or other central bank might want to step into the market and intervene, that is easier to do through secondary market trading rather than primary market. So an example for that was, again, the credit corporate facilities. Both primary market corporate credit facility and a secondary market corporate credit facility were brought to the market, while the secondary market CCF was announced and purchases through ETFs and cash bonds actually happened. There were no reach out to the primary market because, again, the effect of the secondary market intervention happened very quickly. So there was no need for the issuers to step into the primary market. But if you're thinking about how you want to structure such a purchase program, you want to see how your purchases impact functioning. You won't be able to measure that directly through the primary market. Through the primary market, again, because you are intervening in the secondary market and you want to see the direct effect there. So I think that's the other part of the answer. But again, the primary market, if you look at the measures, while they are good for the inflection point, in other times they tend to be noisier compared to the corporate bond market, the secondary corporate bond market. And again, it might be just that we have more signals coming from the secondary corporate market, both in terms of price, in terms of spreads, volume, liquidity, and so forth. So, yeah. But we'll try to add more evidence to convince you more. If there are no other questions, thank you very much for all the comments. They're great, and we'll definitely take them into consideration in future versions of the paper. Thank you very much. Like, I couldn't ask for a better crowd.
Okay, thank you, Or. That was a great talk, and thanks to panelists.
Bye.
All right.
Thanks a lot.
Bye.
Thanks a lot.